Hi everyone. Welcome to today's webinar. I'm Hemant Gangulia, founder and CEO at Rally Tax. Today I am accompanied by my co-founder Dinesh and Mr. Abhishek Batra, who's a CPA with more than 15 years of experience. He's also a CA from India. He's based in Canada today, and he has a CPA license both for US and Canada. So he's the perfect person today to share more light on a very interesting topic, which is US India tax compliance. I've been in the US for 9 years now, and one thing that always gives me challenges, it's like, am I doing it right in terms of compliance, especially cross-border? And being in US also means that you have to comply, and as an immigrant, sometimes it's just kind of scary in some sense to make sure like things are doing right and you're not losing anything that might come back later, right? And there is obviously the thing that US taxes global income, and in fact I didn't knew about it for a long time. I'd been in the US. I'm sure pretty much all of us could have been in the same boat. It took me like few years to realize that, and then few more years to actually implement on it, right? And this this lack of awareness should not be, I feel, the cause for people to fail to comply. And today's webinar will share more light on how to do it right. What are the different incomes or assets, whether in the US or in India, how to protect them to make sure you're not paying too much, but at the end of the day, you're also making it easy for transferring wealth to your loved generation, right? So with that, let's begin. I'll also quickly share about INRI and Rally. Um, Rally is a vertical US product for US taxes. We offer tax filing, tax advisory to US individuals. It could be expats too. However, we do particularly do US taxes. And Rally started out of INRI when I started INRI 3 years ago, with more than 16,000 users worldwide that we have on the platform. And through those insights, we realized to branch out US tax and make it available for everyone. And we are excited to get started given the tax season, and look forward to sharing more today. Thank you. Over to you, Dinesh.
So Abhishek would be covering today about cross-border tax compliance, and Abhishek, you could take it from here. Abhishek, you're on mute.
Yeah. Sorry. Good morning, good afternoon, good evening to all of you joining from different parts of the world. And there may be people joining from India also. So, good evening to them. Quite late for them at this point of time. Today, we are going to discuss about the US and India tax compliances. And let's start with who is this relevant for? It's primarily focused on US citizens and green card holders of Indian origin, or the persons who are working in US on different visas, having income in US in different visas, residing in US, and those who are planning to go back to India or leaving out India. And there may be different people, different kind of incomes which you have, and how the taxability of this income in different heads is being classified and taxed. US, I'm not going to discuss the taxation system as such, but just to give an overview, US taxation is based primarily on citizenship. It's contrary to what is there in India, and as Hemant mentioned, and it's in parallel with provisions across the world. You are a person, individual is taxable for his income on his global income in the country in which he is residing. US has a different concept wherein they have built in the citizenship also. If you are a US citizen, then you have to file the tax returns, irrespective of your location where you are. And your global income is taxed. You may get some reliefs in the form of credits or exclusions, but it is mandatory for you to file your return if you are a US citizen, no matter where you are. And your global income is taxable in US. That is the US based taxation system. First of all, we have to determine what is our status, which is very important for determining what kind of credits, what kind of investments, what kind of planning which we can do. And especially in the year when you move to US, from India, then there has an option of a dual status return, whether you can go for part of the year as a non-resident, part of the year as a resident, or you want to go as a full year as a resident. So there are different options. As mentioned, US citizens are primarily taxable in on the global income, and similarly is the case for the green card holders unless and until they surrender their green card. Apart from these two categories of individuals, there is a presence test, which is known as SPT commonly, or substantial presence test, which is a legal term, which says that number of days of stay over a period of last 3 years has to be calculated to determine what is your residential status. Depending upon that, you file as a resident alien or a non-resident alien. US concept has alien concept. Anybody who is not a citizen is an alien for them. So they say it as a resident alien and a non-resident alien, and that is determined based on the substantial presence test. Anybody who is a green card holder, he is a resident alien, or he can be said as a resident. Uh, Moving on to the Indian tax residency, there is a distinction between resident and a non-resident. Resident is a person who is residing in India for more than 182 days, and a non-resident is a person who is residing for less than 60 days and subject to a condition that in the previous 4 years he has been less than 365 days. It has an exception in relation to the year in which you move out of India for your work. Then your condition of 60 days changes to 182 days. Similarly, when you go back to India, if you return to India, there is a concept of RONR, which is known as resident but not ordinary resident, which is generally applicable for 2 years for the people who have been outside India for more than 7 years. Then they can qualify as a resident but not ordinary resident. It is a quite important distinction to be made at the time when you are filing your taxes after returning to India, because your taxability of the income earned outside India is determined on the fact whether you are a resident, ordinary resident, or a resident not ordinary resident. Because Indian income is anyways taxable in India, it is only the global income which you earn outside India is determined based on the residential status as an ordinary resident or a not ordinary resident. Today in the budget, the finance minister has made a special exemption for 5 years to residents, non-residents who are moving back to India, subject to a condition that they work for a specified project which is notified by the government. In that case, that practically it will be a situation where the person will be classified as a resident but not ordinary resident for 5 years rather than 2 years, and they may not have be required to fulfill the condition of 7 years, which is there when you are to qualify as a resident but not ordinary resident. It is still a proposal. There may be some changes into it, but yes, it can be a very important decision to be made when planning to your back to India. Because one thing which is very important, that exemption notification, is that it should be for a notified project. Hopefully, what I feel that it's basically targeting technology people who are moving back to India for working in the semiconductor or AI space or data center or something like that. That would be the intention, but it's still to be seen. But today morning they proposed it, and it's there. What are the basic common incomes which, when we are filing of taxes, we are talking of taxes, these are the common incomes which we see for persons residing in India. One is that US salary income is there. Apart from the salary income, they may have consultancy and freelancing income if permitted in US, but in India also they have some kind of income from India. If they are doing some kind of freelancing job, they're getting some payments in India and all those things. They have, certainly everybody has a bank account in India. If you have an Indian connection, it's hard to believe that you don't have Indian bank account and you don't have deposits in that account. So there is an interest element attached to it. Apart from that, you may be owning a home in India and US, you may have a rental property, investment property. For whatever person, you may have a rental income. So these are the basic four income streams which we generally come across. So based on this, we are going to discuss what kind of risk we have when we talk about filing the taxes in India and US both, because the same income is going to be taxed in US as well as in India. One of the striking features as far as taxation of US and India is the fact that they follow a different year for taxation. In US, you have a calendar year which is January to December, but in India it's April to March. Earlier, there used to be a term known as assessment year, previous year in Indian taxation. But thankfully, our finance minister Nirmala Sitharaman today gave away with those distinctions, and she defined a new term, tax year, which means a year starting from April 1st, 2026 to March 31st, 27. So henceforth, there would not be any previous year or assessment year. It's in line with all other countries. We are going to have a tax year, which is starting on April 1, 2026. There may be some different rules of taxability of income, which may lead to a double taxation kind of a risk. Like in case of rental income, especially in India, there is a concept of flat 70% taxation. You get whatever rent you get receive, that is taxed at the rate of 70%. 30% is a standard deduction kind of towards the maintenance and the municipal taxes. But that is not this taxable income for US. In US, the income what is taxed is actual money received minus the expenses which you have incurred. You may not have incurred 30% of the rent as expenses. So you have to pay tax on, it may be 90%, 90%, or in case you have incurred expenses which are exceeding 30% of your rent earned, then you may have a lesser income. Many a times, what I have seen that many people filing the taxes, they take the income which is reported in the Indian income tax return in the US income also. So that's not correct. You should always take the income what is actually earned, that is rent minus the expenses paid. Expenses include the interest also, whatever interest you pay if you have a loan against that property. And that loan does not mean or necessarily required to be interest paid or to a bank or a financial institution. It can be an interest paid to your father or relative, anybody else. It's all the tax planning tools which we can use, and we can accordingly claim the benefit of the interest which we pay on that income. Apart from that, the another risk which we have is the currency conversion. Dollar has been depreciating, and everybody has witnessed that today, day before yesterday, it almost touched 92.5 also. So there are risks because the investments which we make or the income which we have in India has to be correctly converted, because it will always give you a lower income when you convert. And at this present time, let's say you have an income of 10 lakh rupees as rent, but in dollar terms it won't be, uh, when you might have rented, it might be at $1,000 a month, but today it may be less than $1,000 a month because of the currency conversion. So you always take care of the currency conversion. This is very important, especially in case of capital gain transaction, which is the income when you sell any asset. The asset which you sold has to be valued on the date of the acquisition. At that point of the time, the asset valued would be much lower at valued at a currency rate which would be much lower than what today is. So you have a higher cost. So that's why you make sure that you use the correct conversion rates both for the at the time of sale of the asset as well as the purchase of the asset. This is quite important for avoiding the double taxation risk, so that the same income is not twice. Now, moving on, how can we avoid double taxation? The, the basic tool which we have for avoiding double taxation is the double taxation avoidance agreement, which both the countries have, and which they have shared certain kind of information, and they have defined what all the taxation rules would be. They have a residency tiebreaker rule in case a person moves to US or moves to India, whatever may be the situation, and he may be ending up in a situation where he is taxable in both the countries as a resident. His stay in India, being due to the difference in the calendar year and tax year concept, it may be more than 180 days. He's a US citizen also. So, what kind of situations? How do determine the residency tax breaker rule defines what kind of situations? There are specific articles in the double taxation avoidance agreement in relation to salary, which country is going to tax it, whether India is going to tax it or US is going to tax it. FTS, which is commonly known as, is the fee for technical services, which we generally have, interest and royalties and capital gains. There are specific articles. One should run through those articles if you have any kind of a situation where you have to avoid double taxation agreement, because only one country can tax primarily. The other country has to give you the credit for the taxation. This is the double taxation avoidance agreement, because double taxation avoidance agreement is a relief of the tax which you pay to one country in the other country in which you are residing. It is not an exemption, it is only a relief. For example, if you are earning rent in India, as per the double taxation avoidance agreement, the property which is located in India is liable to be taxed in India. Income arising from that property is liable to be taxed in India. So whatever tax you pay in India has to get a you have to get a credit for that in US. Similarly, moving ahead, like interest, there are special rates for interest taxation in India. If you are a US citizen, there is a special rate of 15% in the double taxation avoidance agreement. But banks always deduct tax, or in the financial institution or wherever you have the investments, they might be deducting tax at a rate of 30%. So there is always a situation that you can have a 15% refund on the tax which you have got deducted on your interest or rental income, whatever it may be. Because across the world, it's not in India, across the world, when a taxpayer is making a payment to a non-resident of any income arising within that country, he is liable to deduct the tax. So if your tenant is giving you rent, then he is liable to deduct the tax, and you have to claim the credit of the tax which he has deducted. So these are the basic requirements for claiming the foreign tax credit in both the countries. US gives you the credit for the tax you have paid in India if you are determined as a resident of US and you are liable to pay tax in US. For claiming the credit, you have to file Form 1116. There are different baskets, income baskets, which we have already discussed: salary, rent, interest on property, capital gains, interest and royalties. And there is a concept of carry forward of excess credits also in US. On the other side, in India, if you are determined to be a tax resident of India, whatever tax you pay in US, you will get credit of that in India. This is a common situation with people who are moving back to India because they are having 401k, IRA, whatever it may be. And whenever they withdraw that, there is a provision that it's going to be taxed in the US and taxes deducted by the financial institution you are holding those investments. How to claim the credit is to be filing your Form 67, which is a file form which you have to file, and it is a mandatory form which is to be filed. If not filed, the departmental or the income tax officer may reject you the claim of the foreign tax you have paid. One of the issues which we have generally is the timing mismatch because of the different tax years in both the countries. So you just align your tax years. Many a case, what happens, a property is sold in the month of January, which is taxed in India in financial year 25-26. Let's say I sell a property in February 1st, today, 1st February 26. It will be taxed in India in 25-26, whereas it will be taxed in US in 26. Similarly, if you sell a property in April, it will be taxed in 26-27 for the Indian tax laws, but it may be taxed in 26 itself in the US tax. So we have to, what is required in this situation is that we have to maintain a proper documentation about the proof of payment of the tax. Because generally, whenever property is sold by a non-resident, then the tax is deducted and it is required to be deducted for that matter. There have been changes today in the budget also regarding that issue of regarding non-resident getting their property sold in India. There is a lot of relief has been given. A new system of lower deduction of taxation has been introduced, wherein they have said the tax would be deducted at a lower value automatically. You have to do it. It will be digitalized rather than going to the officer and claiming the credit and all this. So moving ahead from foreign tax credit, what are the compliances? These are the basic compliances which I have always seen that when you are talking about dealing with US residents, what are the forms which you are required to file? Everybody is aware of 1040, which file 1040. We have already discussed 1116, which is a foreign tax credit. Along with foreign tax credit 1116, there is a schedule 3, schedule 5, which you have to maintain. Then you always have to file FinCIN FBAR 114, which generally some people might miss it because they're under the impression that they are not having total. One of the conditions of FBAR is that the cumulative amount has to be seen, and at any point of time, if you have exceeded $10,000, then FBAR is required to be filed, and you have to report all the assets, all kind of financial assets which you are holding. It's not a tax form, it is only an information form. You just provide the information, and that information goes to a different department which is known as FinCIN. And it was a specific department which has been set up by the US government to check for evasion of taxes and money laundering transactions. It goes along with your 1040, but it is a separate form which you have to file. Apart from that, we file FATCA, which is 8938, which goes along with your 1040 to IRS. FinCEN goes to a different department, FBAR goes to a different department, if 8938 goes to IRS. Then most of the cases, people tend to forget about to filing 8621. 8621 is a form for filing your taxes in respect to PFIC. PFIC is the passive foreign income investment. All kind of investments in mutual funds, ULIPs, are generally classified as PFICs, especially in case of India, because there are three category. There is only one category which is QEF, wherein you may not be required to file 8621 every year, which does not get satisfied in case of India. So, in wherever there is a PFIC, you have to file 8621. Whether you opt for being taxed on a mark-to-market basis, or you want to tax at the time of sale of your asset, that's an option which is given, but that does not dispense the requirement of filing 8621. 8621 is a form which is to be filed for every investment. It's not a cumulative. If you have 10 different funds, then you have to file 10 different 8621. Another commonly missed form is 3520. Life is ever changing. There can be any life changing event. You may make some kind of inheritance or something like that, and at that point of time, whenever there is an inheritance, by you should file form 3520 to report the inheritance which you have made. In this form, it is not a tax form, it is only an information form. It gives you the it gives the information to IRS that this is the assets which you are holding outside India, outside US and in India, related to the assets which you have inherited, and it gives you a basis for the cost. At the later stage, whenever you plan to sell the asset, you will require a cost basis to deduct the cost for that asset. And 3520 provides you an evidence or supporting documentation for claiming the cost at that point of time. Like, you have inheritance or some gifts which you have received in 3520, you have to report the gifts which you give to your friends, family outside US, in India. If you're in relation, your brother, sister, parents, anybody, you may be gifting some kind of assets or investments or money, actual physical, you can transfer to their bank account. In that case, if the asset or whatever the amount you are gifting exceeds the threshold limit which is set up by IRS every year, for the previous year it's $19,000. If you have gifted or given money which you are not likely to receive and you intend to be given as a gift, then you have to file form 709 reporting that this is the amount of gift which I have given to my friends and family in India. And that it is also not going to tax, because you have a lifetime gift exemption limit, which is a quite higher limit, which is $13 million for the previous year, and it keeps on changing. So if you have given a gift of more than $19,000, then you should file this form 709. It's not going to tax, but it's going to reduce your lifetime limit by that amount of the gift which you have exceeded. Let's say if you're gifted $50,000 to your brother in India, then $19,000 is the limit within which you can give. So 31,000 is going to reduce your lifetime limit. It's not going to be taxed, but it's going to reduce your limit. It's important from the estate tax point of view. So that's something which you have to do. Coming on to the Indian assets, when you are filing your Indian return, in case of non-residents, till the time you are a non-resident, you are not required to report any kind of foreign assets in Indian return. There is a scheme which has been launched by the government today in India for the small taxpayers who are having assets and income in foreign outside up to 1 crore rupees. But right now we are talking about the assets which we have to report in US in our FBAR. So that is to be reported in FBAR and in FATCA 8938. What we have to report is all Indian bank accounts and deposits, all kind of mutual funds, demat accounts, pension funds, PF accounts, insurance policies, especially ULIPs. Many people tend to forget this because they had to be treated as mutual funds only. ULIPs, they are as good as mutual funds. These reportings are based on the thresholds. FBAR has a lower threshold, whereas FATCA 8938 has a higher threshold. So you can accordingly, based on your threshold, you can decide which all forms. But generally, $50,000 is 50 lakh rupees. I guess many people qualify for that, and those who have been staying in US for more than 3 to 5 years, I always find they have assets more than $50,000 in India. These are the common mistakes which we do when we are filing our US taxes or preparing our US taxes. One of the things is that there's a presumption that Indian income is tax free. Like Hemant just pointed out that when he came into Canada, came into US, he was thinking, not aware of the fact that the global income is taxable. Many people feel that a PPF interest, which is exempt in India, is tax free in US also. NRE bank account interest or NRE FD interest, which is tax free in India. There was a judgment few days. It's not a new judgment. There was a old judgment, but few days back there was a social media hype and everything created where it says NRI investments are tax free. NRI investments were never taxable. Income from those investments were taxable, subject to the fact they are not invested into NRI FDs or NRE FDs or NRE bank accounts. If you are investing into mutual funds through NRE accounts, that does not mean that income arising from that mutual fund will not be taxing. These all those accounts which we just discussed, there is a common generally belief that I have to see each individual account exceeding $10,000. That's not the case. If one account also exceeds $10,000, then requires FBAR reporting, and FBAR reporting mandates every account to be reported, whether it has a transaction or no transaction, balance or no balance. We have to make sure that the correct exchange rate we are taking while reporting on our taxes or FBAR, whatever we are doing. Every year, the exchange rate changes, and it's advisable to check the rate. IRS releases the tax rates, and you have historical tax rates available from the IRS website, wherein you can go and check the tax rate for exchange rate for the previous years, whatever you are requiring. Let's say if you purchase a property in 2005 and you're selling it, you need to check that exchange rate for 2005. You cannot take the exchange rate for 2020 or 2021 or whatever it may be. One of the things related to foreign tax credit is the documentation, because these days a lot of things have become quite easy as compared to something like 5 6 years earlier, where foreign tax credit availability was very restricted and it was requiring a lot of. These days a lot of information is available round the year. You have form 26 as available in India for the taxes paid in India. AAS is there. It is available on quarterly basis. And practically speaking, I have handled cases wherein foreign tax credit is allowed based on those statements because they are government issued and publicly available statements. And if the tax authorities wants, they can get it verified. There is no issue with that. So you need to maintain proper documentation, especially taking care of the fact that the different years are involved, tax years are involved in both the countries. Moving on to non-compliant, as we discussed, what are the mistakes? Now, moving on to what are the implications of the mistakes or whatever error we do is that we have penalties attached to them. FBAR penalties are there. Everybody is aware of. We can discuss and debate all those things for a day or two, whatever it may be. But there are a lot of penalties. There are wrong. If you are claiming incorrect credit, foreign tax credit, or the DTA has not been correctly taken care of, or because especially in case of foreign tax or technical services, fee for technical services, it is taxed in both the countries. Anybody who's a tax resident of US is having any kind of technical services income from India, then India also taxes that, but at a lower rate of 15%. US taxes it at a normal slab income. Same is the case when a US citizen, Indian resident is receiving income from US. The US government is going to tax 15% of the income arising from US, irrespective of the fact that the person is resident in India. If the income is arising in US, then you are liable to pay tax on the consultancy and technical services income in US at the rate of 15% as per the double taxation avoidance agreement. India had this Black Money Act, which was introduced in 2015. It talks about all the undisclosed foreign assets, and that's the primary reason for the disclosure scheme which came in today. Because at over the period of last so many years, a lot of changes has happened. Income tax have already started investigation in many cases involving foreign assets. Now they had in the 2 years back they had come out with a provision wherein you uh, Now, NRIs who are returning to India, they were given a option that they, if they want, they can defer the taxes on their IRA or Roth on whatever investment accounts which they are having. Like in US, they are not taxed. They can defer the taxability till the withdrawal or till the time the money is being received by them in their accounts. There was an option. This option is available only for US, Canada, and limited countries, not for every country. But yes, US citizens and US non-residents are given an option is that if you move back to India, then you have an option of deferring your taxes in your Roth account or IRA and 401k. But in the previous years, this option was not available. And there have been cases where investigation and procedures have been started and the Black Money Act notices were issued. Black Money Act has a taxation system wherein 30% is tax on the income and 90% is penalty. So if you have not reported any income of $100, then you end up paying $120 in Black Money Act. Now, since in last 3 years they gave this option, they wanted to streamline everything. So probably that's the reason they have come out with this scheme, which is known as FAST, Foreign Asset Small Taxpayer Disclosure Scheme, in which tax is going to reduce to only 60% rather than 120%. Apart from interest penalties, an important aspect is the interest. Penalty is something which may be waived off, may be given a dispensation with, because penalties are always levied when you have a malified intention. In case it is proved that you never had a malified intention and it is a bona fide intention, penalties is something which is optional, or the officer may can give you a waiver for that. But interest is something which is not optional. It has to be paid. And if you, let's say, if some not reported any transaction 4 years back, in India, we have a rate of interest of 12% on taxation, though it moves up to 48%. Similarly, in US, the same concept of penalty is there whether it's in US or in India. It doesn't make a difference. Penalty in US, first time offenders, there is a scheme for first time offenders which are given an exemption in US. It's always you have to have a bona fide intention. And in case you don't have bona fide intention, penalty is levied. But in case of bona fide intention, penalty is not levied. However, interest is always charged. There is no provision, both in the US and in India, which can save you from the interest. Apart from that, there is always a prosecution risk, because if misreporting or improper reporting has been done, then it is considered as a criminal offense in many of cases, and which can lead to prosecution also. Now, with this background, we can now plan what are the opportunities which are available for planning. One of the foremost opportunities for residents, non-residents in US who are moving to India is the RONR situation. RONR is a unique situation wherein income earned outside India is not taxed for the first 2 years when you become a resident of India. That is the primary leverage. And when you have investments in US in the form of equities and you become a non-resident in US, that income capital gains is also exempt. So it's kind of an arbitrage that the first 2 years, if you sell your assets, especially your investments in equities, you are not taxed in US, and at the same time you are also not taxed in India because of your ROI status. That income is earned in US. One of the foremost things what you have to see is that whenever you realize those money, you don't actually get that money into India directly into your Indian bank account. You should get that money into your US bank account and then transfer it to India. That's something which you have to plan accordingly, so that you don't end up paying taxes, because income is taxed in the country where it is earned and received. So if even if it is earned outside India and received in India, then it may be taxed. Similarly, in US can be a situation. We can always time our capital gains. Timing of the capital gains is quite important. There may be situations of inheritance. What is the time when their parents might have purchased the property, when you actually acquired, when it got inherited by you? You have to determine which year, and accordingly the taxation. There is a difference in taxation in both India and in US, especially as far as inherited properties. We have to check our foreign tax credit optimization, that proper taxes are being paid in both the countries, and if I have paid tax in India, then I should get the credit for that in US. There are restrictions while providing the foreign tax credit up to a certain amount. The credit is always available only to the amount of tax due in the resident country. Let's say if you have paid $10,000 as tax on a particular income in India, but the corresponding tax on that income in US is only $8,000, then the credit is restricted to $8,000. You cannot get that $2,000 back. Many a times what happens when claiming foreign tax credit, people tend to claim credit based on the TDS certificates or the 26 AS, whatever the statements which they have for tax deductions, assuming that that is the tax which has been paid by them in India. But that's not the case. If you have claimed any refund on the income tax return in India, then that amount has to be reduced from the foreign tax which you have been deducted and paid by your payer. Similarly, you have to plan regarding your green card. If you are exiting and you are planning to surrender your green card, then you have to plan a lot of things regarding your assets, property, whatever you hold. And if you don't do it, then you are still liable to file your taxes in India for the taxation in US. You have to file your taxes in US for all your global income. In that case, there is a foreign income exclusion clause which gives you up to $120,000 if you earn actual income outside US and you are actually considered as a tax resident of that country and not in the US. In that situation, there is a foreign income exclusion clause which allows you relief for the double and saves you from the double taxation, especially in case of green card holders if they don't plan to surrender it. These were the few compliances and requirements which I have come across and which I feel everybody should take care while they're filing the taxes, since we have our tax season ongoing right now, and one should always take care of these. And now we can move ahead and we can help you with all these, whatever we have discussed at INRI and Rally. We have a team wherein which we can help you in tax filing your taxes both in India as well as US. We will ensure that the foreign tax credit and double taxation, whatever benefits are available to you, are being made. The assets are properly disclosed and all compliances are done. And we can certainly help you with your planning when you are returning to India. That's all from my side. Now, I would request Hemant
Yeah.
to tell us briefly about whatever the fund plans are.
Thank you, Abhishek. Appreciate the lot of insights that we had today. We'll do a Q&A, but before that, I'll just take this moment to quickly talk about our fundraising plans. We are in the midst of fundraising, and fortunately, so far, uh, we've raised the first check from Y Combinator, and after that from angels. A lot of the angels actually we had today are customers. So in the past 3 years that we have built this brand equity, we have been loved back by our customers who want to participate in the growth journey that we have been building so far, both at INRI and Rally. And this is an opportunity if you are an accredited investor, more importantly, and are interested to participate in the growth of this company, you are welcome to invest in this company. These are some of the metrics that we are gonna achieve. So revenue milestones, we're looking at 1,000 customers. This is just particularly for Rally that I'm talking about, 1,000 customers by end of April, and then 2,000 by end of this year. And this is a small round, 500,000 angel round, and we're planning for a seed round, which would be a multi-million later in the year. I can chat more if you're interested, and you can drop me an email at hemant@rally.tax. I'll put that in the Slack, in the chat. Thank you.
So,
Now
thanks,
we
Hemant.
can.
Abhishek, there are a couple of Q&A questions. So,
Mhm.
Arushi asked if we could discuss on the compliance related to buying house in India, whereas being resident of US.
I'm just trying to stop share. Hmm. Uh, Buying a house in India is not a challenge these days. There are a lot of, if you deal with the most of the builders, there is only issue when you are buying a house property in India that's specifically related to farm property. But as far as buying a house in India by a US resident, there is no challenge. You can simply buy it. There are many companies which have US investors. For that matter, there is a recent study which I come across that Godrej Properties is having maximum non-resident investors rather than their local investors. Their properties are being sold to non-residents in India. So, if you can elaborate, what is your challenge regarding the property? As far as taxation is concerned, there is no issue from taxation angle in buying the property in India. The one thing which
So,
you have to make sure is when you are buying a property, there is a concept in India wherein the buyer is required to deduct 1% of the payment which is being made to the seller, and it is the duty of the buyer to deduct the tax and pay to the government. And you don't require anything, it's based on your pan. And if you are buying a property from the builder or developer, whosoever it is, with any person, just make sure that you deduct that 1% and pay that 1% by the 7th of the following month in which you make the payment. That's the only taxation requirement, I would say, for a non-resident in buying a property in India.
so I have a quick question, Abhishek, on
Yeah.
that. So if there is no rental income, you're just buying a house and there's no rental associated with it, would
Yeah.
there be some tax implications being a US resident?
If you classify that property as your self-occupied property, that if whenever you move to India or whenever you, let's say, go for a month or do whatever time it is,
Hmm.
then you say that it's my self-occupied property, then there is no rental income. No, it is not mandatory to have that. Especially in case you have more than one properties, especially then it's a situation where you have to have a deemed income, or you have to comply with certain other requirements so that deemed income is not taxed for you in India. But if it is only one property, then it can be classified as a self-occupied property. There was a proposal that this limit of one may be changed to two in this budget, but it has not gone through, and the proposal has not been passed. So it has not been introduced in the budget. But as far as one property is concerned, there is no taxability in India. You can
I
have that.
see. Okay. Thank you for that information.
Yeah.
I think
Um,
PFIC, Nick asked about PFIC, which you've already discussed. Gift City,
Gift City, as far as Gift City is concerned, as for a US resident, there is no much tax advantage from US point of view. It is not taxed in India because Gift City is a special economic zone which has been created by India. So it's deemed to be outside India. So any income earned outside India is not taxable in India for a non-resident. But it does not save you from the US taxation. So you have to pay tax on that income, even if it is earned in Gift City. Mm,
Arpan question, I guess you answered it, right?
I have FD principle and non-binary for taxation. How does I interpret AIS? As for your interest, you have to convert that every year. At the end of the year, you calculate what is the total interest and take the rate which has been taken given by IRS for conversion of US dollar into INR, and report that in your other income in US returns.
I have a question. Yeah, I'm Arpan. Hi.
Hi,
So,
Arpan.
since the tax year durations are too different, so the AIS might be telling about will be taking into account till April. So January to April, you have the extra interest, but the tax year in US is still December, January to December. So should I be paying 3 months more money, like on the interest, or how does it work?
AIS is updated by income tax authorities in India on quarterly basis.
Okay.
It goes, though you can up check whatever the tax, like for filing your taxes for 25, you need to check what was the interest for the quarter of January to March 24 from your AIS of previous year.
Okay.
And for the current year, you can take it from the AIS for 25-26, which
Okay.
would be available to you by end of February, because 31st January is the last date by which all the persons who are deducting tax or banks who are reporting incomes,
Mhm.
they have to report to the Indian income tax authorities. So 31st, by 31st they report it. Probably by 10th, 12th it gets updated, but depending upon when the banks or the financial institutions have given that information. So it is advisable to check by end of February your AIS. You will have your income for the first 3 quarters, June, September, and December in your AIS for financial year 25-26.
Okay.
And it will also have the information of the tax which has been deducted on it. So that can be used for your foreign tax station credit, because it's a government issued document. That is one of the documentation which you have to maintain for claiming the foreign tax credit.
Sure. One additional question, just one additional small question. So I have given sent money, so less than 19,000 to my mother,
Yeah,
and additional 4 or 5,000 to my father.
yeah.
So all total, it's more than 19,000. But if you look at two individual people, blood related, mother and father, so both are like below 19,000. Do I need to report it as a gift tax or something like that?
No, 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 you don't have to.
Okay.
It's 19,000 for the donor, donee.
Okay. Thank you. Thank you so much.
But, moving on to Kunal, what is the best way to reach out? Uh, Kunal, you can reach out to Rally, and you can reach out to through Rally for your. You can book a meeting through them, and that's not a problem. Is there a provision to correct or report F bar had not been reported? Yes, you can do your corrections. There is a scheme under which if you have not even reported, then you can also do that, which is a specific scheme. The US government had introduced that scheme, then they changed it. But if there is a bona fide case, yes, there is a provision wherein you can file your taxes or report whatever have not been reported in the past. What are the requirements for an NRI for filing in India? US income and assets are not reported in India, correct? What is the requirement or threshold for reporting dividend income in India? What I do normally, if you have income more than 250,000 rupees in India, then it is required to file your taxes. Or you have a refund of more than 5,000 rupees, then you have to file your taxes in India. Even for the refund of 500 rupees, you have to file your taxes. If you want to claim that money back from the government, then you have to file the taxes. This is a basic requirement. In case of persons who are not having a tax refund kind of a situation, in this budget today morning itself, they had said if all taxes have been paid and no taxes due from the non-resident, then they are not required to file the returns. Earlier, the limit was 250,000 rupees, or if the amount is beyond a certain amount and certain income, then it was irrespective of the fact that tax has been paid or not, you were liable to file your return. If in case you don't file it, there is never used to be any kind of an issue. The only issue used to happen is that the judgment which I was referring to, or the social media post which was there regarding NRI investments, was the fact that income tax officer had issued a reassessment notice that person has not filed the return. Now the government have said in case of non-residents, if all taxes has been paid and no return has been filed, all taxes has been deducted and got paid, and no return has been filed by the non-resident, then the income tax officer cannot reopen or send you a notice for filing the return. It's not mandatory now anymore with this budget, but earlier it was mandatory.
So that limit of 250, 2.5 lakhs is not there anymore. Is that the
No,
way to interpret it?
yes, yes. If
Okay.
the only condition is that you don't have any income on which tax has not been deducted. Let's say if your tenant is not deducting tax on it, then you are
No, I
liable.
got you. I got you. No, but for dividends and you were in
Yeah, for
equity,
dividends and all those,
yeah,
what I would suggest is that you should always file your taxes in case of dividends, because in dividends,
you get
the
something back. Yeah.
you get the refund back.
Yeah.
There's amendment in today's budget regarding that also. You can inform the depository. Now, earlier, what happened that the dividend was taxed by the company paying the dividend, and you
Yeah.
had to inform that I am a non-resident and I don't have income taxable, and they, in that situation, they would have not deducted the tax. Now they have dispensed with that requirement. Your depository, if you file form 15G and 15H confirming that your income is below that threshold limit, then or the rate is lower and all those, then the tax would be deducted at a lower rate. That there's a advantage which is being, that is something which good which has been done in this budget, that they have streamlined taxes for non-residents in these two fields, especially in case of non-deduction tax deduction, in case of real estate as well as dividend.
Gotcha. And then if you could just maybe who would be the best person, to contact? Because this is, you guys are obviously knowledgeable and things have changed. I would love to connect. So an email address or something. That'd be great.
So
Thanks.
Vivek, you can go to rally.tax, and when you sign up, you can select Abhishek as your selected expert, and
Okay.
automatically you'll be
Perfect.
assigned. Yeah.
Yeah. Thank you. Bye now.
Yeah. Thanks.
There's a question by Nick for Canada. Yes, I am based out in Canada and I do Canada taxes. And we can hold a similar webinar for Canada, provided there is interest in that. Or you can get in connection with me and we can have a discussion regarding your taxation.
So again, Nick, as soon as you sign up using GoNRI, we automatically will assign you to Abhishek, and he'll be a point of contact directly to communicate.
There is a question from Hitesh regarding gift in Form 09. Form 709 is only when you gift your anybody in India and it's exceeding $19,000. If it is not regarding the tax deduction for your income in India. If you are gifting any money to in India to anybody who is in your blood relation or related, covered by the definition of relative, there is no taxable income for that person in India, and there is no tax deduction. Do we not need to travel to India for buying property? There are different agencies, and Hitesh also has asked regarding property. So there may be a situation where you don't may be required to fly to India to buy a property. There are builders who do that kind of arrangement, and you can set up there are specialized companies who are doing those kind of activities wherein you are not required to travel to India to buy a property. If a mutual fund or ULIP which you were invested in earlier is not actively being invested this year, do we need to declare? Yes, whatever your financial assets you hold, no matter you have a transaction or not, you have to report to the US in FBAR and FATCA. Roth and 401k will eventually be taxed at 60% if we were to be. No, it is not to be taxed at 60%. Hitesh asked regarding Roth and RF. They are not going to be taxed at 60%. They are taxed at the income level which you are, which is the maximum 30-35%, provided you report that in your income in the respective year. 60% is only under the specified scheme which has been introduced today, wherein the person has not reported his foreign assets or foreign income, or in case he has reported the foreign income but he has not reported the foreign asset and he acquired the assets when he was a non-resident, there is a fee of 100,000 rupees, 1 lakh rupees, which he can pay and get that immunity from the Black Money Act. Income is going to be taxed at the slab rate in India. That's not going to be taxed at 60%, but it is only a specified scheme which has been introduced. How are a couple of crore of investments of my uncle treated in the US? And
So this is a gift that somebody gave, and he had bought the assets. So how are they treated? Because these are equities, right? Very old equities.
I am not able to understand how are the couple of
So somebody has
investments.
bought equities, he's passed away, he's gifted it to somebody who's a US green card holder. How does that work?
Okay, you have to report that in form 3520, the inheritance. And whenever you actually sell those investments, if you continue to hold those investments, there is no taxation in US. But when you inherit the asset, then in that case, you just report that in form 3520 that these are the assets which I have inherited, and that is the cost basis for you for claiming at the time when you actually sell it and report it as capital gain. It is a capital gain if it is an investment.
And it's in the US, not in India, because it's a green card holder, correct?
If it is an Indian investment, then India is also going to tax it. Let's say he has inherited shares of Reliance Industries or Maruti or TCS or whatever the company may be. Indian government is also going to tax it, and they would be taxed at 12.5%, for which you will get the credit in US.
Mhm.
Is there any mutual fund limit which only after that reporting is needed? It's a very tricky question regarding 8621. There are limits, but it's not advisable to go by the limits. 8621 gives you an option to exercise whether you to go with mark to market in the year in which you started the investment, or the option that you pay the tax at the time of sale. So it's advisable that you file your 8621 in the initial year and exercise that option accordingly. So that's something which you have to take care. Please do future session of Canada. Is it mandatory to pay tax for unrealized gain? It's not mandatory, it's optional, but it is recommended. Hi, if there is capital gain in April of 25 in India for US citizen, they will be assessed in India for that in March. What will be? In case the property was sold in April 25, you are being a non-resident, your taxes must have been paid, your tax liability would have been determined, and whatever the tax is, the buyer must have deducted the tax. Based on your Form 26 AAS, AIS, and TDS certificate, you can claim that as a foreign tax credit in India, because the assessment is not going to change your tax liability in India, and there are sufficient evidence available with you for your taxability and the tax which has been paid. You can claim that. Alternatively, which many people generally tend to do, is that they seek an extension till 15th of October rather than filing in 15th of. By that time, your Indian tax return is also done, so you can claim that. But that used to be generally the situation when there was no such forms available like AAS, 26AS, and all those things. But nowadays, many people just file it based on that and claim credit on based on that, because now there is no concept of indexation in India or anything like that for non-residents. Earlier, there used to be a concept of indexation. Now, the cost minus sale minus the cost price is the value of the gains, and that is taxed at the flat rate of 12.5% plus surcharge, which is generally deducted by the buyer. Right now, I am a Canadian citizen, but in India, my father has one shop or one home. In future, if it hand over to me, should I need to pay tax? There is no tax on inheritance. Only the income which you earn from that property in future would be taxed in India. This is regarding the query of Ashish. Also, we have agricultural land, and I'm not the owner right now, but in future, hand over to me in cases. Yes, it will be taxed in Canada. If you are selling that property and the capital gains, it will be taxed in India, Canada. In case your value of assets, when you inherit those assets, exceeds $100,000, then you have to report. If you are not reporting them in your 1135, T1135, which is equivalent to what FATCA is or FBAR is, you have to report in Canada your foreign assets in T1135. So
So,
you should report that.
hi Abhishek. So one question: if we sell, then we need to report, or if we got handover, then we need
If
to report.
the moment you become the owner of the property,
So, but if I
they
don't
tell
sell, I don't need to pay anything.
you don't pay anything, but you have to report. Like in US, you have FBAR and FATCA, which are not
Hmm.
tax forms; they are
Hmm.
reporting forms. In Canada,
Hmm.
you have 1135.
1135. So
Yes,
no matter what, but
and the
as soon
threshold
as
limit is $100,000,
okay.
which is much higher
So
than what is there in US.
yes, right. So as soon as like when you like your name would be on that paper, you need to report it, right? Officially.
It is a cumulative limit, not only those assets, all assets. Any
All
asset,
of it.
once you cross that threshold, then you have to report everything, your saving bank account, your PPF, interest, whatever it may be.
It's a combination of 100,000 Canadian dollar.
Yes, 100,000 Canadian dollars, effectively
More
65
than
lakh rupees.
okay, yeah, it's more than 10 if we need to report. Okay, thank
Yeah,
you. Thank you, Abhishek.
yeah. Manoj, having a query. I filed tax returns both in India and US. I have two PANs, one individual PAN in my name, another PAN under HUF. I receive rental income under both PANs and filed tax return accordingly in India. Do I need to take an additional step or report this income? You have to report the rental income in US. That's not a problem issue. You have to report it. There is no other way about it. As far as your HUF is concerned, it is a very tricky issue because HUF is considered, it's not a assessee or a legal person, and in the eyes of US, they are treated differently, and there are different schools of thought regarding its treatment. So that's something we can discuss offline. But as far as rental income in your name, personal name is concerned, yes, that is part of your US tax return and you have to report that. In case of inheritance of property, is the base value treated based on the day acquired in, as per US law, it is the date when you acquire the property. But as per Indian law, it is the date, it is the value at which your parents might have acquired the property, or the value of 2001 in case asset was acquired prior to 2001. Is there a deemed disposition for foreign assets declared when if becomes a non-resident of Canada, let's say move to US? Yes, there can be a deemed disposition depending upon your number of days of stay in US and in Canada. This is in reply to Nick's query for deemed disposition. All assets may be taxed in Canada depending upon your status, how long you have been, and what is the position. I am in US. My mom have farmland in India. Can she transfer that land on my name? What are the taxes? As far as tax is concerned, there are no challenges, but you will have to check the local laws of that particular area in which your farmland is, because there are certain restrictions in local areas for owning farmland by non-residents. But in case of inheritance, it's generally allowed. Generally, it is allowed. For reporting assets on inheritance, does the time of inheritance also step up the cost? Yes, in US it steps up the cost in case of
So,
inheritance.
uh, Abhishek, a quick question. So you just said that for inheritance in US versus India, there's a difference.
Yes,
In India, it's from the origin, like whenever the father or the mother have the assets, right?
yes,
And
yes.
then in US, you said it's when we
The date of
actually the
inherited.
date of
Yeah.
inheritance. I got that. Is it valid for everything, including equity?
Yes,
You Indian equity.
yes,
Okay,
yes, yes. Any asset.
okay. Thanks.
What are the HUF school of thought? HUF school of thought, basically, some people treat it as a trust. In US, we have a concept of trust, which is very common, which is not there in India, which is used with not all that often. But in US, we have a concept of trust, and the tax resident of US having control over a trust have different kind of tax requirements to be complied in US. So that is one school of thought. The other school of thought is that HUF is nothing but a family, and that there is no concept of family taxation in US, so it cannot be taxed. So
But with the trust, you would risk the 39%, right, in the US. So if you treat
yes,
HUF that way, then the
yes,
39% hit also comes your way, correct? Is that a fair
yes,
assessment?
yes, absolutely. There is one school of thought which says that, and it's that it is a trust and income of that trust which is controlled by a US person, then it is taxed in US also. So you have to be careful for that. Do you do cross-border filing for US, Canada? Yes, we can do cross-border filing for US and Canada. That's not a problem. I guess we covered all the questions.
So do you have an email that I can refer you people, Abhishek?
Yeah, you can reach out to rally.tax, and there you can sign up and you would find all the details in there.
So you would be able to automatically select Abhishek as your dedicated expert, Dwarkesh, from Riley.tax to
Okay, and
self-serve
Dinesh,
product. Yeah.
I got the point. So that's a standard route. My other question was, we had a gentleman who was talking about funding. Do you know who
Yes.
your lead fund is?
Hemant?
We have a Y Combinator as the first check that we got, pre-seed money. We don't have a lead for the seed round. This is a bridge round that we are doing to get in early investors, preferably customers, and then we will do the Q1 seed round.
Okay. I'm just trying to understand who's getting involved in the future. Have you locked something? You've not locked something? Are you open? That was the question.
No, so we don't have a lead investor, and the reason is that's why we are inviting people early. If we get a lead, and they'll probably close the round. Yeah.
Okay.
There's a question
Uh,
from Deepak
Hemant,
regarding. Sorry.
sorry, sorry to interrupt. Hemant, I logged into rally.tax and I think I do not get this option of changing my CPA to Abhishek because last year also I spoke with him regarding a consultation call. So I'm not sure
Mhm.
how to do,
So
how to
Hitesh,
change it.
it'll be done in the next couple of minutes.
Sure. Thank you. Thank
Yeah.
you. Yeah. Sorry,
There's a
sorry, Abhishek.
No problem. There's a question from Deepak regarding inheritance not executed in 1 year. It does not make difference when it is executed. The day you got inherited the property, that is the date. You best way is to get a valuation done. This is what I do for my clients. that we get a valuation done then on the date of inheritance in India, and based on that value, we file Form 3520. And this is what I did for my clients in the previous years. Make sure that 3520 is filed along with your return. I guess everything got covered, and probably we are just 10 minutes over. So, and
Great.
I hope.
Yeah, Abhishek.
Yeah, I was just saying that I hope everybody stays safe back, because in Canada we are expecting a storm, and
Yeah. If you want to save yourself, come to California. It's very nice and sunny here. So we're glad to be here.
You're -6, right, Abhishek, right now?
I am in Halifax. It's 3 o'clock for me.
So it's
Yeah.
-6, right now?
Yes, it's -6, but we are expecting a storm any moment. The scheduled time is 3:30 onwards. So let's see how come when it comes.
Play safe. That's
Yeah.
-6 is dangerous as it is.
We
So
are used to it. The -6 is not that bad
no,
for
it
us.
is dangerous for people to get out because the ability for
Yeah,
that
yeah,
cold
yeah.
to freeze, and if you have a blast, the blast can drop it significantly.
Yeah, it's expected to go down till -415, and the feels like temperature is expected to go down as -15. Yeah, probably in next few hours.
Play safe. That's all. Take care.
Thank you.
Great. Thank you, Abhishek. Thank you, everyone, to be part of this webinar. I'm sure everyone had some good takeaways. We will send a detailed email after the webinar with the recording as well later in the day, or maybe in the next 24 hours. And stay tuned for that. And if you have any questions, you can reach out to us at hello@rally.tax, and we'll share a bit more detail on the investment also if you're interested. Thank you.
Okay, bye.
And you can drop me an email at hemant@rally.tax if you're interested to learn about the opportunity. Thank you. And I think one thing I probably forgot, but yeah, whatever. I mean, people are there. So we will offer free US tax filing this year if you become an investor. Thank you.
Bye.
Thanks, everyone. Thanks, Hemant.
You.
Yeah.
Thank you.